Low inflation is currently a common theme in many parts of the world, from Europe to the US and to the emerging markets. With us to discuss central banks' role in this low inflation environment and to provide investment advice against this backdrop is our Global Chief Investment Officer, Michael Strobaek. Michael, inflation rates are very low globally. What's the role of central banks in this environment?
Well, the role of the central banks globally today is probably as differentiated as it could have been. In the US, the central bank has a focus on keeping the recovery going to make it self-sustained, and they're taking a view about a range of variables that they're looking at in adjusting their monetary policy. But inflation as such is less on the radar of the central bank. Is more about keeping the recovery going. In Europe, on the other hand, inflation rates are very low, and the ECB has already started to signal that if inflation rates continue to go lower, or even if the debate about deflation was to come up, that they're prepared to make another perhaps rate move. Started discussions about introducing quantitative easing programs out of a fear that inflation could actually be too low. In Japan, again, the story is once more different. Japan has been in deflation for the past 25 years and has once and for all said under the Prime Minister Abe that they want to address it very aggressively. So they have gone all in on monetary policy to stop deflation, to spur the economy and the consumers to start spending more, and with their monetary policy driven down the yen and also been able, at least for here and for now, to press up inflation. So those three are very different monetary policies. And lastly, emerging markets, again, another place. The central banks there now have to battle capital outflows and high inflation rates. Brazil is one country, for example. India, Turkey, all got hit by tapering last year of the Fed. So once the Fed started, if you will, to become less active, or said they want to become less active, now the emerging market central banks have to become active. So overall, the central bank task today is to either spur the recoveries in the developed world or keep inflation down in the emerging market world, but with a net effect globally that we're still in a very expansionary monetary policy environment.
You already mentioned the ECB potentially engaging in a quantitative easing program. Do you think they really will, given the threat of inflation?
Right now, this is not our central scenario, because we believe that the recovery will continue to pick up, and that as a consequence of the recovery overall, that inflation has bottomed down and should start to move up in the Eurozone. So we don't believe right now that the ECB is going to engage in a broad QE program. It is also a little too early to say. We'll have to see how far the recovery really goes, and if inflation can be stabilized on a low level here and start moving up. But the ECB has opened up, if you will, the box on it, which is very unusual, and markets have reacted to it, and there's probably an expectation by markets that it's going to happen. And markets may actually be disappointed if that doesn't happen. We believe that is a speculation right now more than a central scenario, and that's why we don't really have it as a central scenario.
And what about the Fed? Where do we stand there with regard to tapering? Are we on track, and when can we expect a rate hike?
We're very much on track with tapering. The Fed is exiting its QE program. It doesn't feel well with quantitative easing, and that is a game, a new game for financial markets. The Fed has taken a lead role on QE and is exiting, but it has also clearly said that it will condition its first rate hike on a range of economic variables, and we don't believe that we're going to see a rate hike before the middle of 2015 earliest.
Inflation in emerging markets is even higher there than in the developed world. What's the focus of central banks there?
Well, the focus on central banks is to stem outflows of, if you will, global investors, foreign investors, so that they don't have to too aggressively have to raise their interest rates. Outflows have taken place because of tapering in the US. But the emerging markets have very different issues to deal with than just sort of outflow and rising interest rate in the US. There's a range of structural problems, political programs in a country like Brazil that need to be introduced to make sure that these economies can really, if you will, continue to grow, not just recover. Brazil is close to being in recession, or may actually be in recession, and they need to grow. They need to see, however, that inflation stabilizes before they can start really become, if you will, less tight on their monetary policy.
Thanks, Michael. For more information on market movements and global trends, check out News and Expertise on the Credit Suisse website.